Hello investors, I'm Stuart Kruse and welcome to Kruse Asset Management's Chart of the Day. Today is Market Mondays and we're going to be talking about the Dow Jones and a variety of other markets. Dow Jones hit 30,000 for the first time ever last week. Crossed over it briefly. Trump called it a sacred number. I'm not sure it's sacred, but anytime you hit a multiple of 10,000, it's a significant point to just mark how far we've come over a period of time. So let's look at the chart here. I'm looking at this 1 month chart of the Dow Jones, and here we cross over that 30,000 briefly for a little bit, but still crossed it. And just looking at the monthly percentage returns for the Dow Jones, that was up as high as 11.5% for the month. Still looks like we're up about 10%, which is an amazing return for any particular month. If we add the S&P 500, that's up 9.4. NASDAQ slightly outpaced the two of them, being up 11. And if we look at the international markets, look at this return, 15% on the month. And how far have we come year to date? Well, the international is still playing catch up, and of course, as we know, the NASDAQ is crushing all the other levels at 35%. But here we have. So I had a client ask me, are the markets expensive right now? Should we be getting out? And of course, anytime you go to new highs, you're by definition the most expensive you've ever been. But you can't get to additionally new highs until you've gone through your last new highs. So you always feel like you're expensive. So that prompted me to send a response to him saying, no, of course we're not expensive right now. We are just getting through new highs. Our earnings have come in well ahead of anticipation. And then, so of course the market can't be expensive. But let's really take a look, a deeper dive at this. And I'm going to keep, we know the Dow Jones was at 30,000. I'm going to keep the S&P 500 up here. I'm going to change this to, let's say, a 10-year window. And let's look at the S&P 500 PE ratio. And I'm going to put this on, you know what, let's take the price off. I'm just going to have the PE ratio here. Now, let's change this to an absolute number. So here we have, I was saying the PE ratios on average, 24 is a pretty high number. So let's look at the average PE over time at about 20 over the last 10 years. And that's skewed because it looks like we're hitting 31. So that does indicate that we are kind of expensive right now. And why is it at 31? Well, it's not because the market shot up. If we look at the market again, we go back to adding the PE on here. Yes, the market's up, but it didn't shoot up. So why is the why is the PE moving up? If the P didn't move up, well, that means that the E must go down. So let's take a look at the E of the PE ratio, and the E's have been dropping. So because the price is relatively the same and the earnings have been dropping, then that means the PE is going up. I mean, you guys can do the math, right? So let's take this out here and let's look at what happened over here. You've got a humongous move up and a humongous move down here. So the earnings look like they're drifting down as opposed to recovering. And with this increased COVID prices and more lockdowns and potential negative GDP, is the market expensive? Well, often when we have low earnings, we have a humongous move up in PE ratios. So I'm going to put these back on the same chart, and we're going to look at the S&P 500, the PE ratio, and the earnings ratio. And I'm going to look at a max chart. Let's see, where does this go back to? Let's say the 1990s. So let's really do a chart back to 1990 and compress this all in here. Here we go. January, February, let's do January, 1990. Now, what I'm going to point out here is when you've had a spike, here we're going to look at the orange, which is the PE ratio. Here we had the spike in 2009 crisis where you had PEs just shoot up, and that's mostly because the earnings, the blue line, dramatically fell. But what you'll notice is the market did sell off during that period. And again, when you have a spike in the PE ratio, because here you're looking at average PE, you have a spike in the PE ratio, that's because the earnings sold off. And that was amidst the downturn of the actual S&P. So the S&P is selling off. You've got a spike in the PE because you have a downturn in earnings. Here are the S&P selling off. You have a spike in the PE, downturn in earnings. Here you have a downturn in earnings, no real spike in the PE. Here you have a downturn in the earnings, starting to get a spike in the PE, no drop in price. Here you saw a drop in price. Here you saw a drop in price. Here we have not seen that same drop in price. So I can't tell you that we're going to see a drop in price, but if history is a guide, you're looking at potentially spiking PE ratios because the earnings are falling. I would anticipate earnings continue to fall, which would drive the PE up, which could potentially cause a drop in the price of the S&P 500. So, are we expensive? Yes, we are. Is there going to be a sell-off? I'm not sure, but history would suggest that there would be. So, maybe you want to light up on your on your equity exposure right now, in spite of the Santa Claus rally coming up. Or what I might suggest is you'll probably get a rally into December, is my guess. But as the retail numbers start coming in, you would probably sell on the news. So there you have it. This is Market Mondays. This is Stuart Kruse, trying to help you to live your life with the odds in your favor.